Hello everyone, live from Chicago. I'm Charles Brown, Portfolio Manager with CB3 Financial, and today is Thursday, May 11th, 2023. We are so glad you are with us tonight. The NASDAQ slog and may go away, the saying we should just go away in May and not stick it out through the summer. That's been bantied about for years, and I'm here to disprove why that is something that is wise, because it is not wise. It is simply not wise. Those of you that have been on the program before have seen the topics that we cover. We'll get to each of these tonight in various quantities. If you are new to the program, please go to YouTube. You're probably there now watching us, right? And click the little bell and get every single episode that we have sent to you with a little advice there. Subscribe to us so we can see if this is useful material to you. I suggest that you also follow me on Twitter or Facebook or LinkedIn. I pretty much tweet every day. I guess there's sometimes I miss, but most people, notice that. And I don't know, I've got a pretty big following on LinkedIn. I seem to get feedback from clients and other listeners on there. So check us out there. If you got questions, I do dialogue with people on those channels as well. Our next show is Thursday, June 8th. It'll be early. That's the earliest it can ever be because it's always the second Thursday, and the 8th of June is the next show. So I hope you'll be there. The monthly market review. So when I do this segment, first of all, I need to tell you, we're having a little bit of problems with our camera tonight. So if it's a little fuzzy, I'm sorry about that. We're still trying to get used to the lighting in this new office in Chicago, but by next month, we'll be back to our usual superb quality. So hang in there with us this month. So for years, literally years, because we've been doing this 3 1/3 years now, I've had the split screen. Last week I tried it just with slides, no on camera at all, and the feedback I got was, gosh, we just want to know you're there. So I'm going back to full screen when I really need to just talk to you and tell you something, and then full screen on the slides when there's something to show you. But the monthly review, our month is not from the 1st to the 30th or 31st. Our month is from the second Thursday to the second Thursday, and the reason is because that encompasses a non-farms payroll report on the first Friday of the month. Sometimes it's not the first Friday, but usually it is. And this month it was, and there's good news there, and I will show you that when we get there. But let's go back now and look at the monthly review, okay? So this is a saying that I like here. I try to find these and give them to you every once in a while, but of all the liars in the world, sometimes the worst liars are our own fears. And that is certainly true when it comes to investing. If a picture paints 1,000 words, this next picture is going to do that for you. One of the most important slides I've ever shown you. I don't know about this origin of this, but I think Paul Simon wrote a song, said, Mama said there'd be days like this. There'll be, in my case, on this slide next, I'm going to show you, there'll be weeks like this, months like this, and years like this. So here it is. Look at the crosshair. Look at the date. Monday, May 10, 2021. That's 2 years ago today. Follow it straight across, and that's where the S&P is today. What do you see? Nothing. 2 years of slogging it out. Okay, we hit a new high on January 4th, 2022. You can see that up there, and then straight down, and then trying to make our way back up. But if you have looked in your account and you're seeing not much growth in 2 years, that's why. We are trying to preserve capital during these times. All right, that means we take stops when stocks are going up and then they abruptly sell off because of earnings disappointments. We've had to, I would say, fight the Fed because as they raise interest rates, it makes savings more attractive. I actually opened a savings account at Apple, Goldman Sachs, and I'm getting 4.5%. I don't have a ton of money in there, but I haven't had a savings account in like 25 years. But the rates are so attractive, I have just a small amount of our net worth in there. So this chart just goes to show you that you have to be prepared for this. That's why Mama said there'd be days and weeks and months and indeed years like this. You have to hang in there because you don't know when the next bull move is going to happen. Look to the left of the crosshair and you can see what I mean. That's just straight up. All right, but it hasn't been that way for the last 2 years. We have had 2 consecutive quarters in the NASDAQ of positive growth, and that then defines a new bull market for the NASDAQ, okay? The Dow and the S&P, not so much, but the NASDAQ is 20% off the low, which qualifies it to be in a new bull market. Now, as you folks know, I firmly believe that we are in a secular bull market. So it's not like we exited, went to a secular bear market. We definitely have been and can still be considered in a cyclical bear market. But because the NASDAQ is 20% off the lows, it's returning to its secular bull market behavior, and that's a positive. We're waiting now to see if it will drag along the other 2 major markets, the S&P and the Dow. We'll see. Earnings, this is one of the 2 major components that drives the stock market. So this number that I like to see is 73% of S&P companies predicting that their earnings are going to be good, and 73% of them coming true. Well, you can see we're at 77%. If your eyes drop down a little bit, you can see 419 of the 500 stocks in the S&P have reported. Only 80 left, which means next month they'll pretty much all be done. But look at the numbers here. Consumer discretionary right at the mean of 73, staples 88, energy 86, and most importantly, technology 91%. So why do I say so important about the NASDAQ? Well, the NASDAQ, that was a Freudian slip. The technology sector is 23% of the NASDAQ, and it's roughly 21 or 22% of the S&P 500. So as technology goes, so goes the market. And when you look on here and see that 91% of technology stocks have beaten their forecast. Now, it's important you realize that these forecasts are just one quarter ahead. We're actually going to have some data later on that are full year projections, but they have beaten them even in this downtrodden market. So I find that encouraging. So the employment scenario, I mentioned just a little bit ago that we're a month-to-month, a monthly review from basically non-farm payroll every Thursday after non-farm payroll to the next month. All right. And because the employment scenario is so important, I cover it in here in one of our segments. So the U.S. economy adds 253,000, about 250,000, right, new jobs in April, and the unemployment rate ticks lower. So for those of you that want to pick on Joe Biden and say he's ruining the economy, well, I don't know that you have much of a case right here. I'm not going to give him credit for these jobs, not any more than I gave Donald Trump credit for the jobs when he was providing them. But the economy remains strong even when we have, and I think we can all admit, a dysfunctional government. We have geopolitical concerns. We have high inflation and a risk of recession. All of this happening, and yet look at what we're adding in jobs. All right, if you look at it on a chart, we're going all the way back to June of 2022. So going back 12 months, they've all been positive. All right, last month at 165,000 new jobs, and then the bump up, when I say last month, that's really March, but April, 253,000 is a good number. The strength of the U.S. labor market continues to keep the threat of recession at arm's length, at least for now. The U.S. economy added that 253,000, which was above the 185 expected. And that's why last Friday was such a strong day in the market. The market loved it. In addition, and follow me on this, okay? Downward revisions to February and March meant that the jobs report wasn't strong enough for the Fed to say they want to hike again. And yet the April reading quelled recession fears. So this is the challenge, all right? You think we always want to have good news. The problem with good news is it can be too good. How can it possibly be too good? Because if it's so good, then things begin to heat up, and that drives inflation. So you always want to have the Goldilocks approach, which is some little bit of hot, some little bit of cold, kind of lukewarm. All right. So what that data is showing you is that February and March were revised down. That's bad. Okay. But that makes the Fed say, okay, well, maybe we can, ease off here because February and March were revised down. But April was strong enough that people are not concerned about a recession. Okay, you see the mix there? It's an interesting time for sure. It's a weird time to be entering the job market. The U.S. unemployment rate's fallen to a 50-year low. And yes, that's lower than when Donald Trump was president. Okay, but waves of layoffs and recession warnings continue to break. A lot of these layoffs are happening in the mega cap stocks, Amazon, Microsoft, Meta, formerly Facebook, okay? And in my 30 years of experience, this is just weird. So I'm still relentlessly convinced that you cannot have a recession when jobs are strong, okay? And when the job market is, if you want a job in America, you can find one. Even though it's cooling just a little bit, we still have way more job openings than we have people to fill them. It's really hard to have a recession in those kinds of terms, all right? So what about inflation? Where are we on this? We know inflation's high, but is it coming down? And is that enough? All right. So inflation eased to 5% in March. Now, at one point, it was as high as 10.5%. So it's been cooling. Now, you might say, well, 5% is still way too high. Well, it is. All right. But it's cooled to the lowest level in nearly 2 years. The CPI report, which was yesterday, today we had PPI. So CPI is the Consumer Price Index, and it was in line with what we expected. So the survey was for a 0.4% increase. The actual was a 0.4% increase. Now, you're not seeing inflation rate here on this chart. You're seeing the rate of change. That's really important. All right, so look from 21 up through about halfway through 22. Do you see how those blue bars just keep increasing every single month? And then they start dropping. There was a plummet, all right, in the 7th month, July of 2022, and it's been moderating since then. And that's what we need to see. You're not going to go from 10.5% inflation back down to the Fed's target, which is 2%. Now, the market would love that. Actually, it would kind of behave erratically if that were the case. But it is moving in the correct direction, and that's why I'm showing you this data. So what about a recession? What is the possibility of this? Well, if you look at the data, and again, I don't watch the news, I watch the data. Investors are now less certain about an impending recession. And why do I care about investors? Because they're the ones spending the money. They're the one investing. As you know from many, many shows of mine, there are 3 components to GDP. The first is consumer spending, which is about 67, almost 68% now of the economy in the United States and elsewhere around the world too, but it's really high in the U.S. All right. The next component is government spending. The next component is business spending. I'd love to see more business spending, less government spending, but I digress. All right. So that is a positive that investors are now less certain about an impending recession. The relationship here is complicated, okay? Kind of like the movie there with Meryl Streep. So you can see during the last recession, we had massive unemployment and job openings just went down. Well, now what we have in this very short, you see the little tiny gray bar in 2020, that's the 6-week recession that we had where unemployment spiked, but then it dropped way back down. We're at a 50-year low, as I just mentioned earlier. Job openings still strong, although they're pulling back. But the gap between the blue line and the red line represents the amount of job openings that are out there with people that we just don't have to fill the jobs. This is significant, and it just continues to be pervasive here in a positive sense. We need about 1.8 people more than we have in this population if we want to have full employment, because the jobs are just sitting there waiting to be had. Now you might say, well, how can this happen when these mega companies are laying off people? Well, they overhired. They just overhired. I have a family member who works for Meta. He's got a great job. His job is safe and solid, but he's got people above him, people below him that are losing their jobs because these big companies, rather than be left out in the cold, if the economy was going to heat up, they wanted the workers in place to produce the widgets. Well, the economy didn't exactly heat up, so that's why these mega cap companies, more so than just your run-of-the-mill S&P 500 company, are laying off people. All right, and you can see it in the chart as well. So, all right, so significantly, 58% of companies issuing full year guidance have delivered a positive result. Now, remember earlier we were at 77%. All right, and that's fine. But this is a full year. So 58% issuing full year guidance, that's really, really strong and positive. The economy is continuing to defy recession forecasts, and that is a great thing. So U.S. policy, why do I talk about U.S. policy? Because policy comes from politics, and I realize most of us dislike politics. Now, that doesn't mean we don't like talking about it, but the political process to actually get to producing policy can be very, very frustrating. But policy has personal impact, and that's why I have to talk about it. Okay? So Treasury Secretary Janet Yellen has warned that the U.S. could run out of money to pay the nation's bills as soon as June 1st if Congress doesn't raise the $31.4 trillion debt ceiling. This is an issue. It has always been an issue as long as I've been alive. Actually, not quite, because Bill Clinton, Democrat Bill Clinton, had a balanced budget in 1994. Seems unfathomable. Just less than 30 years ago, we actually had a balanced budget, and the debt was very, very small, but that is not the case today. So what happens is Democrats and Republicans go to negotiate. They're at loggerheads. They just don't want to work out. They want the other side to move. And yet Yellen has warned of severe consequences for the U.S. if the debt ceiling isn't raised. Well, we all know that. We have never, as a nation, defaulted on our debt. We've never defaulted on our debt, and that's really important to understand. It would be catastrophic if we were to default on our debt, because the biggest gap in the number system is between 0 and 1. I know all the numbers are supposed to be equally spaced, but psychologically that is not true. And think about it in your life. Your first time for this, your first time for that. I'll let you fill in the blanks. But the first time the U.S. defaults, it means the second time will not be as difficult. And then it becomes third and fourth and fifth, and all of a sudden we're Brazil or Venezuela. And once you do that, the credit quality of the country is in serious jeopardy, and our status as the dollar, as the reserve currency, is also threatened, and that is truly catastrophic for us as the world's leading economy. All right, we don't want to give China an entry here. So the two sides were prepared to meet tomorrow, and I didn't update the slide after 4 p.m. today when the Speaker of the House called off the meeting, so nothing's going to happen tomorrow. And we are 2 weeks from running out of money. So the other political impact, obviously February 22, the global economy started what became an unprecedented event. The West, led by the U.S., severed trade, financial, and personal ties with Russia. Now, Russia, I don't know if you're aware of this, but it's the only country that spans 11 time zones. There are only 24 time zones. It's at the heart of Eurasia, so it's the only country that straddles 2 continents. And it's essential to global commerce as a supplier of key commodities, and it attacked Ukraine. Obviously, we know all of that. But before that, our punitive measures tended to target countries at the edge of the global economy, like Venezuela and Iran. Now, maybe Iran wouldn't appreciate being called at the periphery of the world economy, but sorry, you guys, you are. When we started implementing these major sanctions, plus sending arms to fight against Russia, even though we weren't ourselves sending personnel in there, it became a major statement. And the longer this lingers, the more the pot boils for a possible major conflict. And of course, the market has had to live with this now for over a year, and I don't see it going away anytime soon. Unsurprisingly, growth forecasts for 2023 are revised downward because of this. All right, so the 2024, we're already looking ahead to this. It's hard to believe. A year and a half from now, we have another election. Kind of wish it didn't seem so rapid here, but the GOP is favored here. But the problem is the wild card are the candidates. If the GOP puts forth candidates like they did in Georgia and Pennsylvania, it's going to be a problem for them. All right, so they're going to need to find some strong contenders and avoid intra-party fights. I don't know if you've noticed this, but the Dems don't seem to fight nearly as much as the Republicans do. They're way more unified than the Republicans are, and the Republicans are in the minority, so they really can't afford to splinter. But they do anyway, so we'll see what happens. This is what the map looks like for the upcoming race. So we've got solid Republican, more solid Democrat actually, but the flipping over of the seats does favor the Republicans. And Joe Manchin, of course, the main middle-of-the-road Democrat in West Virginia. It'll be interesting to see. That's a toss-up. You can see there are 3 toss-up states: Ohio, West Virginia, and Arizona. Kerry Lake down there, obviously. So it's going to be interesting to see how this plays out. But the big news of the week, can you believe Donald Trump went on CNN? I mean, he went on CNN, he did this town hall. A lot of people really liked it. Honestly, I haven't watched it. I've had a really busy week trading and doing analysis. I plan to watch it this weekend. But, the ever-ready battery here, the ever-ready bunny just keeps going and going, and we'll see. I don't know if you watched it, but it's going to be a very interesting political season next year for sure. All right. I just want to give you something to think about here while I take a quick break and get a sip of water and another cough drop. When you're pulling the lever to vote for someone, I hope you're thinking about this. Our First Amendment rights are, in my opinion, being attacked right now in this country, and it concerns me. And there are a lot of components to First Amendment rights. People always think of speech, so let's start there. Okay, but to the left of that is information. We have a right, the Freedom of Information Act, to get pertinent information that affects our lives, that doesn't, negate the need to have top secrecy and secured documents. I get that. Freedom of the press, freedom of thought. Nobody can tell us what to think. Freedom of education. We can choose to have public or private education or no education. Freedom to assemble as long as it's done peacefully. Freedom of association. No one can tell us what kind of friends or who we can have as friends. Freedom of movement. You can move from Illinois to Wisconsin and back to Illinois and then to Tennessee and then back to Illinois. Maybe not the most sane thing to do, but we have freedom of movement from state to state. And of course, freedom of religion, a very, very big component of that. So I would urge you, when you're looking at candidates at the local level, the state level, and of course the national level, to see where they stand on First Amendment rights. These freedoms on this page are so cherished by, I would think, virtually all of us. And there is no guarantee that they're going to be here for the next generation. So just think about that, if you will, all right? I'm going to pause for a second and look in the chat box, see if I missed anything. Oh, Keith Day, love the Skyline Chili. That's for you, Dr. J, there in Cincinnati. So one of my Chicago friends, Keith Day, traveled to Cincinnati. He had Skyline, a 5-way, okay, and a Grater's Cheese Crown. He might have had more than one, but he didn't tell me, all right? So I just wanted you to know that. Hey, Greg, good to see you. Hey, Deb, of course, and Deb in South Dakota. Both Deb. What's cooking, Deb? And good evening, Charles. Good to see you there. All right. So, I don't know how things are where you are, but it's kind of chilly here in Chicago. I've enjoyed this cool spring. When I was in Tennessee, it was very warm by this time of the year. So I'm enjoying that. Anyway, those of you that have watched the show know that I track certain economic indicators, and I follow these because it gives me a look ahead. So we go through the monthly review, and then we look at the components that make up what's happening in the market. And that's the market performance, that's the political scene, that's inflation, that's the debt, obviously all the political implications. But then we look at economic indicators as a forecasting tool for the things that I'll be talking about in the next show or the next 2 or 3 or 4 shows. All right. So that's why they are important. That's why this segment is important. So in the economic indicators, this one's kind of harrowing. All right. Less than 60% of baby boomers own retirement accounts. Now, that is pretty chilling because the baby boomers are the largest and oldest demographic right now, and I don't know what they're going to do. I guess they're just going to end up working forever unless their health gives out. But part of what we do at CB3 Financial, and I'm sure you guys know this that are clients, there's 2 aspects to what we do. My show is primarily about portfolio management and how we make decisions for your accounts. But the other thing we do is financial planning. And that's so that you can look at your current situation, your savings, what your future pension might be, your Social Security flow, etc., and make a determination on what your lifestyle will be when you stop working, if you stop working. All right. And if somebody's not doing that for you, they need to be. All right. It can be us. It can be somebody that you know in your area. But guys, don't let this become you. All right. And I know if you're my client, you're not in this position because we've had this discussion. But very important to keep saving as long as you have earned income. And even if you're working in retirement in your late 70s, you can still contribute to an IRA as long as it's earned income. So another stat I'm looking at, and this is a sentiment stat, all right? Sentiment meaning it's not actual data like jobs being lost or gained or widgets being produced or not being produced. U.S. small business sentiment slumps to more than a 10-year low. So on the left-hand side is the optimism index, clearly going the wrong direction. And on the right is the capital expenditure. So it looks pretty much the same. The point being that right now, small businesses are concerned. They don't have the padding that big companies have. So what Meta or, Microsoft or Amazon does, they just lay off people. Now, I think it's pretty brutal when you read in the news that, 16,000 jobs are gone, 12,000 jobs, 8,000 jobs. That's just crazy. I mean, it's a lot, and it affects tons of humans and their psyche and the community, because think of all the trickle down that the money that will not be being spent. So it's important that small businesses are able to continue to attract talent, employ talent, pay their talent, and that they stay optimistic. It's tough to stay optimistic if you listen to the news. And even if you just look at the data that's happening with the items that I cover on this show. One of the reasons why I want you to tell others about this program is because we are optimists here. It's not like we're just rose-colored glasses. We look at the data, we see what it's really telling us, and what it's telling me is that the underlying tone is we are still in a secular bull market. The American economy is resilient because Americans are resilient. And that's a message that you, and I think probably everyone in your life, needs to hear. Okay? So this is an interesting quagmire. Word of the day, quagmire. Okay? So non-residential construction spending. This could be roads and bridges and schools. It's not necessarily office buildings, because we know from the situation with work from home that not a whole lot of new office building construction, although there is some, is happening right now. But what happens is this sector of the economy is so strong that it's just taking a while to slow down. So why do we want it to slow down? Because this is what's driving inflation, one of the many components that's driving inflation. And the longer it takes for this to slow down, the longer it will be before the central bank, the Fed, can cut rates. So this is that dichotomy that we face right now. You would think we would always want things to be growing and strengthening and improving. But if it does so too much, that's when inflation comes in, because people raise prices, other industries raise prices, and it becomes difficult if the rate of increase in prices inflates faster than your salary's increasing. There are plenty of people that have had to take on 2 jobs during this recent 2-year period of time. All right, with inflation going from basically 0.7% in January of 2021 to where we are today. Actually, to where we were a year ago is even worse than where we are today. All right, but that's what happens. All right, and that's why the Fed has to jump in. We are seeing credit card debt in line with pre-COVID trending. So you could say, well, that's not good. People just putting debt on their credit card. Well, you would hope that most people are sensible and that they are capable of paying off their debt. That's generally the case because most people don't want to lose their home and other possessions because they get repoed. All right. So when people are spending, you know from 3.5 years of listening to me say this and earlier in the program, 68% of the U.S. economy is driven by personal spending. So the fact that people are spending on their credit cards in general is a good thing as long as it's done within their financial capacity. Okay? All right. So the Fed. How can we ever do a show without the Fed? I showed you this slide last month. And I just love this slide. There he is, Jay Powell with his selfie. And I did all this red on the screen. I did it, folks. It's just me. Yeah, I'm probably unkind to Jay Powell. But the truth is, the Fed has totally blown this whole inflation mismanagement, raising the Fed funds rates at a meteoric rate. And it has put an already difficult economic recovery strung it out a lot longer. And that's why the market, that first slide that I showed you, which if you were bored, you could just take that one slide and say, this is what I learned tonight. The market's exactly where it was 2 years ago today. And why is it? I'm giving you the reasons why. All right. So Jay, don't keep doing this. All right. The confidence in Jay Powell. Look at Alan Greenspan. He was just such a great guy. He's still alive. It's hard to believe this, but he is. Ben Bernanke and then Janet Yellen, awful, although she, started getting a little bit of tailwind there and her ratings went up. Jay Powell went up, almost at 60%, never approached Greenspan, and now he's at a new low, okay? So you can see where Democrat presidents and Republican presidents, doesn't seem to matter, all right? Confidence in the Fed chair is the lowest in decades, all right? And here's why. Time out, Jay. Time out. It's ready. This economy is ready for you to stop raising, all right? The last raise we had was last week. It was expected. It's a variable rate, 5% at 5.25. It's got a 5% bid, 5.25 offered. And that needs to be the top. It just needs to be. They know it. We all know it in the industry. And it needs to start easing down. It needs to get back to that target of 2%. Now, I am in the camp where I think we will be at 3.5% near the end of the year, or certainly at the end of the first quarter. I think that's how quickly it's going to drop. I really do. So it shouldn't have taken this long, but that's what we're expecting. So the Fed raised, as I just said, 5 at 5.25, and the central bank officials removed the guidance. So when you go to a press conference, read what I said there, okay? Remove the guidance, had pointed to further increases. So we all watch the Fed announcement, all right? And some of us trade it, okay? Either bonds or euro or something like that, because it's so volatile. And it used to be, it was just when the rate was announced because the press conferences weren't covered. Well, now the real volatility happens during the press conferences. And if he just puts a period in the wrong place instead of a semicolon, it can just trigger emotions because people are trying to read. It's the biggest psychiatric inferment, word of the day, inferment, inferring what he means by that. There was a time 2 press conferences ago when he paused and cleared his throat, and the S&P dropped like 8 handles just during that time because people were perceiving, okay, he's not saying we're done yet. We're going to keep raising, okay? And markets don't want to see that. So during the last recession, you can see we peaked out at 5.25, and then a recession ensued. Where are we now? We're at 5.25. Look at the right side of the chart, okay? What could happen after that? It could be a recession. This is what people are pointing to when they say, hey, historically, when rates start to come down, that's when a recession happens. Okay, just because it happened that way in the past doesn't mean that it'll happen that way in the future because it was a different economy back then, all right? So in 2008 and 9, we were losing jobs left and right, and you can see the rate plummeted to 0 because it had to. The Fed had to charge the economy by dropping the rates that low because there were no jobs. We don't have that situation now, so I don't think we're going to see that aftermath. I know people are predicting it. I'm not one of them. Could we have a mild recession? Sure. We had a mild one in 2020. We recovered right away from that. The key is jobs. Will jobs stay strong? The data that I'm showing you, until it changes, says that it's going to stay that strong. All right, housing market. Housing market. So we bought a house in Chicago, actually a condo, and we sold a house in Tennessee. So somehow in all of this, we had pretty strong pricing. We had to pay up here in Chicago, but we got a pretty good rate. We actually had a bidding war on our property in Tennessee, which helped us, and we were grateful for that. The survey was for a 0.5 drop, and again, that's done on a monthly basis, and the actual 0.4. So we're lagging a little bit on data here. I need another couple months, so I'll bring this up for the next time I show it to you. But in general, this 20-city home price index is showing that inflation rates for housing are just dropping. And this is a good thing for the Fed. Remember what I've been saying. If this was continuing to rise like it was in 2020, 21, 22, then the Fed would say, see, we got to keep rising because If houses keep, going up this much and we're seeing 25, 30% appreciation a year, nobody's going to be able to afford a home. And even now it's difficult. When we left Tennessee, we left a 2 5/8 interest rate to have a 6 1/4 in Chicago. Ouch. But I plan to be refining at least a couple times in the next 18 months because that's how fast I think interest rates are going to drop. Watch it. We'll be talking about it on this show. So the number of new home listings continues to fall. See the blue arrow down. And the reason is because people don't want to put their homes on the market because they have a low interest rate. It's like, if I can get interest rates back down to 3, 4 maybe, but just to pick up and move, unless, like in our case, we had family here and we're so glad we came back. We were having just a wonderful time with our grandchildren and our children. But unless you have a really strong reason like that, it's tough to leave a 2 5/8, 2 7/8 rate to get a 6 rate. And that's why people are not putting their homes on the market. So the median sale price follows in hand and it's dropped below the 0% line. So we're back to below 2012 annual median sales price. All right. Again, it depends on your market. We had an actual 46% gross gain from what we paid on our property in December 2020, and we sold it this month in May of 2023. So we're happy with that return. It's not unilateral all over the U.S., but still pretty strong. All right, so the reason I have added this CB3 methodology segment is because those of you that are clients ask me, what's going on? We really aren't growing any, all right? And there's truth to that. And you saw that early slide. I happened to find a time when the S&P was virtually exactly at the same price it was 2 years earlier. Now, if it had been 2 months or 6 months, you could say, okay, I get it. Or a year, it's like, really? Okay, that was a bad year, but the next one will be good, right? Well, no. It's actually 2 years of not doing anything. What that means is, though, that the market is what we call coiling. And yes, you can think of a snake that coils up. What happens when a snake coils? It's getting ready to strike. Now, in the market's case, it could strike up or it could strike down, but it's about to make a pretty big move one way or another. In my 30 plus years of experience, that's what happens when the market is coiling. Because I believe we're in a secular bull market, I, of course, think it's going to be up. All right, we'll see. All right, so our investment methodology, and you've seen some of this before, but I want to reiterate it, drive it home. Those of you that are clients really need to understand this. Those of you that are just watching along and maybe want to think about being a client, well, here you go. So the major change in my methodology since October 22, and this goes back to basically working with Tom Basso. You guys saw that interview. I hope you've seen the interview. It's actually the most watched video on my entire website. It was my part 1 interview with him. Part 2 we're doing tomorrow in Chicago. So I'm really excited about that. But I'm simply no longer willing to risk a loss target of more than 1% of my equity. I'm not willing to do that. I got a message that I've got to, let's see, do I have somebody here? Had a message in the chain. Okay, here we go. Charles, sorry, I didn't mean to take so long to get to it. So your thoughts on the banking crisis and impact on the stock market. With now 4,800 U.S. banks insolvent, more banks to go, bankrupt and crash. Okay, so certainly it's not 2008. I don't know where you get the 4,800 number. I'd love to see that data. I guess I could imagine 48 to 50, but I'm not seeing 4,800. Part of the problem is this is just the natural. Let me go back to camera here. The part of the problem, or the reason this is happening, is the same reason that people lay off employees when they overhire. We have too many banks, and we have mid-tier, we have small, and we have mega cap banks. Okay, those mega cap banks aren't going anywhere, especially because they have so much oversight from the Fed, so that we never have another 2008, 2009 again. The very local banks in the rural areas, have very strong devotion from their local people and ranchers and bankers. And my brother is in a small town in Montana where the local banks there are really strong because everybody knows everybody. It's kind of like one of those TV shows, right? But the mid-tier banks, it's hard to attract capital when the investment banks or the investing of the banks in California that went under, rather than investing in treasury bills or other I would say lower risk investments, they were investing in tech companies, and a large part of their portfolio was there. Why the regulators didn't see this, I don't know. But I think this is going to be a wake-up call. I don't see this as catastrophic for the U.S. economy at all. I'd really like to know what that number is. I'm not seeing anywhere near 4,800. I've been seeing 48 to 50, maybe 75 tops at the top end there. If there are more banks to go or bankrupt, the FDIC is going to step in up to 250. I think it's time to raise that FDIC insurance probably to 500. And of course, you can get that, if you just have two accounts. So if you have, husband account, got 250 in it, 250 cash, the wife has 250, a joint account has 250, a joint savings account, so you got joint checking, joint savings. So the titling on the account makes a difference. But anybody that's keeping $3 million in cash in the bank shouldn't be doing that. Okay, it should be in the market somewhere. But I digress. All right. So this requires me limiting most stock position size to 2, 3, or 4%, other than ETFs, which have different risk characteristics. And as a result, portfolio growth may be slower. Why? Because we get stopped out of positions. My winning ratio dropped from about 40% down to 31%. You might say, well, why would I want to do this? Because I don't have the huge losers anymore. All right. And I'm going to show you graphs and just a little bit of CG. Those of you that have been with me since day one or before day one of, CG's track record starts in 2011, because that's when we left the broker-dealer world and I just was a pure registered investment advisor. But the concept here is that the drawdowns will be lessened with a fixed equity risk amount attached to each investment. And again, this goes to the work that I've done with Tom Basso, a multi-millionaire, really brilliant trader. And he has graciously taken me under his wing, and I've interviewed him for his book. Again, that's a plug. If you haven't seen it, you want to see that interview first, and then watch the one that we do tomorrow. Will probably come out in about a week or so, and that's part 2 of his book. It just jumped up on the rankings at Amazon because he's talking about things that people really need to hear that, again, you're not hearing in the mainstream media. Okay, so this is the cumulative benchmark of CG. So the blue line is CG. This is my actual trading account. And this is percent growth, okay, since September of 2011. That was the day that we moved to Interactive Brokers, again, from our broker-dealer, and we had total control over the data and could do this. So you'll see we pretty much tracked the S&P. We had some peaks above it. We had some below it. And then I really went on a winning streak in 2020, halfway through 2021. But when the market corrected in 2022, you see a really big drop there. And that is because I did not have risk management in place. I was more a buy, and it's not like I didn't have it in place, but I didn't have it to the degree and to the tuning that I have now. It was more the Warren Buffett mindset of buy and hold, and it will eventually come back. He has some stocks that he's held for 30 years. I don't have any that I've held that long now. But you can see slowly, while the S&P is flattening out, that's the yellow line or light green, whatever it looks like on your screen, the blue line is starting to become strong and coming back. Do I think that we will eventually catch up with the S&P and increase and go past it? I do. And I'm also convinced that when the next major downturn happens, we will be prepared as an all-weather trader. And if you want a definition of that, you'll need to watch the interview that we have. Okay, that's the name of Tom's book. So this is a comparison time period-wise of the S&P to SG. And you can see in 2018, 2019, the year, the months and the quarters that we were outperforming. That's why I highlighted the blue line there. But look, also in 2020, we got whacked way worse than the S&P. That's why the blue line's under the line there and the other yellow line. But the white areas are where we're starting to outperform the S&P using the risk management strategies that I have developed. So one thing that people will ask is, okay, so why do you do this? I mean, why do you continue to manage this? Those of you that have been with me know that at one point I sold my book of business And yet I continue to manage clients, and I do so to this day. I have absolutely no plans to retire, and I can tell you one of the reasons why, and this is that. So Warren Buffett, 92, and Charlie Munger, his vice president, pictured here at 99. This is last weekend. Warren opened it up, I should say Mr. Buffett, saying, we've got our own King Charles here today. So Charlie Munger, 99 years of age, and there they are answering questions from 30,000 people. This is as classic a story of American success, multi-billionaires, that you can find. Why are they still doing this? Because anything else they did would have a lesser impact on society and in their lives. That's my assertion. I've never been able to ask them why they're still doing it, but I can guarantee you that they're doing it because it helps them to feel significant and like they're making an enormous improvement in people's lives by the investments that they're managing. That's what I love about what I do. That's why I do what I do. Because when we sold our book of business in 2014, I was probably fine for the rest of my life. But the market remains a challenge. And it's the biggest challenge. Oh, I could argue some relationships in this life are, but I digress. You guys know about that, right? You've got them in your own lives. But as far as a mental challenge, I like the ability to wake up every day and see what's happening, look for the opportunities, look for the best risk-adjusted opportunities for my clients, and provide for them the best risk-adjusted returns on their portfolios that I can find. That's what just lights my candle every single day. All right. There we are, guys. That's the show, the segments that you see. The next show, Thursday, June 8th. All right. Hope you'll be back for that. If you have not read the book, you should get this book on Amazon, or at least listen to our interview, which was done in March. The book just skyrocketed to the top of the investing/trading/psychological book there. And so, give it a shot, guys. In my opinion, retirement should be your second life and not a waiting room for death. All right? That's how I see it. And I end every program with, for we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. That's from 2 Timothy. Let me look in the chats here and see what we have. Housing in Naperville is still very hot. I totally agree with you on that. Hossein, good to see you on the show. Thanks for being there. Anybody else? Any questions? Anything? Again, sorry for the camera. I don't know what's going on here tonight. So, but at least you can see me. I'm here. Let me know what you think about the format. So we're doing full screen on me, full screen on slides. We want you to be able to watch this. I had one of my viewers say, I watch your show the Friday afterwards because I have a church meeting every Thursday night. And I go for a walk and I watch it on my phone full screen. So I really like the fact that you're full screen on the slides, but come back on camera. Well, here I am on camera. Hope this helped. Thanks for the upbeat words there, Deb, and all of you. Until next month, if you have questions, cb3@cb3.com. Stay optimistic. We live in the greatest country in the greatest time in our lives. There will always be challenges, but let's stay together. Let's stay together as Americans, and we're going to make this work. Please remember that at CB3 Financial Group, we don't just manage your assets, we become one of them. God bless you all. I'll see you soon.